I think we'll go ahead and get started then. And so just a couple sort of announcements. First of all, thank you for being here. We appreciate you showing up and participating. We're going to talk away here, but if you have questions, please feel free to raise them. We have people on the phone and in a webinar format, so for those folks, again, if you would mute your phones so that we don't hear background noise. For those folks, if there's questions, you can submit them through the chat function, and we will try to get to those as well. We'll be watching for those. What else? Silence your phones? I'm not going to say that. You can take flash photography if you like.
If you do have questions, just raise your hand and we will either take them on the spot, or if there's something longer that's going to take a little bit more detailed conversation, we'll take them at the end. Right.
And so just to introduce ourselves, I'm Cheryl Morrison. I'm one of the shareholders here at Gray Plant Moody in the trust estates and charitable planning arena. I also have a foot in the nonprofit group when it comes to charitable giving and charitable trusts and those kinds of things. And Barry, do you want to introduce yourself with your specialty?
I'm Barry Clegg. I'm a partner in the firm's business and tax department, and I get called in to look at weird gifts like this.
Yep. Yep. And Jennifer Bishop was going to join us. I just had a realization this morning she had someplace else to be, but I think it was Florida, so I'm not actually sure if that's where she is. So we're not sure where Jennifer is. But she was going to join us, but was not able to with that conflict. So why don't we start out? We're talking today about gifts of business interest, charitable gifts of business interest. And people in the room could be at different levels in terms of their giving departments and kinds of gifts they've seen before. So we're going to kind of hit some easier points and some more complex points. But we think all charities should be looking at least the possibility of getting business interest as gifts. You know, it helps to know what that's about, what you have to think about, that sort of thing. But if you're dealing with a donor who is a business owner, it's very likely that his interest in his business would be, I'm going to try to get our thing working here. We're on. One second, now you have to help me. Oh, yeah, can we, with people on the phone, if you could mute your phone. I'm not getting we might have to use the computer. Yeah, let's use the computer instead, can we? Okay. Or not? Just a moment, folks, we're having difficulties. So we should just be able to go forward and back.
Chris, we know you're listening out there.
Sorry, folks.
Chris is our IT person. He's on.
Do we have the printout of this in the materials, Jessica? Okay. All right. All right. So we'll just get going with the folks here in the room. You have this on a printout mode in your folders, so we can start with that. Did you get it? Okay. Okay. Good. Now we'll see if we can do this. So, so as we were saying, gifts of business interest for business owners, that may be one of the gifts they can give. That may be their single largest asset that they can think about in terms of supporting your organization. Also, as well, as baby boomers retire, you may be facing more of these kinds of gifts because as we talk about the say it again.
There's somebody out there who doesn't have their phone on mute, so we're getting a lot of feedback.
I don't know that we'll do anything with it.
Can everybody turn their phones to mute? Thank you.
So that we'll get it.
I think somebody
All right, folks, sorry about that. So in terms of the baby boomers that might be retiring, as I was talking about, those folks who are philanthropic, they may have a strategy they can use to help in business succession, passing the business on to their kids. But it's also important to note that business interest gifts are more complex, both for the donor and for the charity. So it's important to know that when you face these kinds of gifts. And while those gifts may be sizable, there are some risks that the charity needs to think about in terms of potentially accepting those kinds of gifts. So the format for today, we're going to be talking about kind of at this front end, laying some groundwork. What kinds of business interests might you be looking at?
We're trying to turn it down.
Okay, thank you. So what kinds of business interests might you be looking at? What are attributes? Barry will cover that. I'll cover some of the tax considerations that donors might face and charities might be alert to. And then we'll cover some types of gifts that you might be thinking about when you're looking at business interests and matching those types of strategies to both your institutions and the donor's goals.
This is probably remedial 101 for most of you, but just talk about the types of entities that you might be getting gifts of. Most common would be a gift of a corporation. As you know, corporations have limited liability for owners, which is a good thing for you because you're going to be taking that gift and you'll be taking any liability that comes along with it. There are two kinds of corporations. A corporation. C corporations are virtually all publicly held companies, but a lot of privately held companies too. And C corporations pay their own tax, so no income flows through to the owner, which is a good thing if you're concerned about UBTI. S corporations do not pay their own tax. The income flows through to the owner. So if the owner is a 501c3, that creates potential UBTI problems because all S corporation income is UBTI. Talk about partnerships and LLCs for a minute. The first kind of partnership and the most basic kind is a general partnership. If anybody ever offers you a general partnership interest, turn and run the other way. Because it means two things. First of all, as a general partner, you have unlimited liability. And second, it means that the organization is probably not run very well because anybody who was a general partnership should have switched and become a limited liability company or a limited liability partnership many years ago. But that's the basic risk associated with the general partnership is you take on your share, you take on everybody's share of all liability. A limited liability partnership is basically a general partnership that filed an extra form with the Secretary of State, and they achieved limited liability for all their partners. So it's not really very much different from an LLC, except on paper. A limited partnership is a partnership where the limited partners have limited liability, but the general partner does not. There are also requirements that limited partners may not participate in management of limited partnership. Now they have fancier things, such as a limited liability limited partnership, or even the general partner has limited liability. If you're potentially receiving a gift of a limited liability partnership interest, you can probably achieve your goal of reducing exposure. Partnership doesn't pay tax either. The income flows through to the partners. The default is that it flows through on a pro rata basis, but the partnership agreement can really say anything. There can be A classification partners, B classification partners, C classification partners. There can be waterfalls, as it's called, of how the income is allocated and how it's distributed to the owner. So all that's very important, and we'll get to that when we talk about due diligence. More and more commonly, you will see limited liability companies. Owners have no exposure beyond their interest in the LLC, and the LLC is usually, but not always, taxed as a partnership. The default for an LLC is that you are taxed as a partnership, but you can always check the box and elect to be taxed as something else. That would be a C corporation or even an S corporation. So all of those things are possible. So that's another item under due diligence where you have to find out how that entity is taxed.
And I'm going to cover just some of the taxation groundwork that will be helpful as we talk through some of the actual strategies. On this page and in your materials, there's a chart that just shows you some of the basic income tax rules. When a donor is looking to take an income tax deduction, the questions the donor will be thinking about is, what kind of property am I giving? To which kind of entity am I giving it? And those two main questions will determine the level of the donor's deduction and the amount of the donor's deduction. Where we are today will be in the third row, appreciated long-term capital gain property, other than qualified appreciated stock, which is publicly traded stock, which is not our topic for today. We'll be in that third row when we're talking about income tax deduction available to the donor, because that's where the business interest will lie, is in that third column. So typically the donor is going to be looking at deduction up to 30% of roughly adjusted gross income. If the gift is to a public charity, if it's a gift to a private foundation, the deduction is going to be less. The donor will get a fair market value deduction unless certain conditions exist. And so let's talk about some of those special rules. A donor's deduction will be affected, if you will, by a couple different ideas here. If there is debt associated with the business, the gift may be treated as what's called a bargain sale gain, which would attribute some gain to the donor upon making the gift. There is also a number of rules, or there are a number of rules that would otherwise reduce the donor's deduction if certain circumstances exist. If there's ordinary income items held by the business entity, that would reduce the donor's deduction. So there's a number of complicated rules that would affect business interests here that the donor is going to need to be aware of. And while it's not your issue, because the donor's deduction is not your issue, it is important to keep in mind that the donor is going to be thinking about these things, and if he's not thinking about these things, he should. So it's important to be aware that there are some complex and special rules when you're dealing with business interest type gifts. The last one is a big one, and both Barry and I have dealt with a number of these types of questions. It's a very common question in the charitable giving arena, and that is, when is there a risk for a donor making a gift of property that donor will recognize the gain on that gift? So let's just put that in an example. If a donor has appreciated gain, type property, so I'll use some simple numbers. If the donor has a piece of stock in his company that today is worth $10, but his basis in it is $1, if that donor sold that piece of stock, there would be $9 of capital gain. If the donor instead gives that stock to charity, the donor can take a fair market value deduction, so $10 for that stock up to the applicable limit of his adjusted gross income, and he would not have to recognize the gain. So there's a, there's a charitable deduction, and there is non-recognition of that gain, which is kind of a double benefit. If the donor has arranged for the stock to be sold immediately upon the donation, then the IRS can argue that that donation should be treated as if the donor had actually sold the stock first, took in the gain, will be taxed on the gain, and then made a charitable contribution of the proceeds. So the donor doesn't get the double benefit. The donor only gets the charitable deduction benefit.
Technically, that's not your issue either.
Right.
It's the donor's issue because you still get the gift, but if that happens, you have a honked off donor.
Right.
So you do have to be concerned about it, but my advice is to keep it as the donor's issue and not your issue for a couple of reasons. Number one, you don't want to be giving legal and tax advice to the donor, and number two, any conversations or emails or anything else that you have with the donor are not privileged. The IRS can and will come in and look at those. So keep it the donor's issue. Definitely recommend the donor go consult their own counsel.
Definitely. We get these questions from our charitable organizations pretty consistently. I would say once every couple of weeks, we get a question about this prearranged sale idea and what is the risk. Again, it's not the charity's issue. The charity should be aware that the issue exists. So if the donor comes to you and says, I already have signed a purchase agreement, or we've got this option, or we're closing tomorrow, and I want to make the gift today, you have a, not you, the donor has a prearranged sale issue, okay? The issue exists. Your job in that is to alert the donor, if he isn't already alerted, that that is an issue and that he needs to talk to his tax advisors. In the context of business interests, this is an important topic. When you talk about a closing happening tomorrow, what if the company is being sold, okay? And how close is that sale? How far has it proceeded? What about the situation where a gift of a business interest is made and the children are waiting in the wings to purchase it from the charity? What if there's an agreement that they can do that? So there's sort of gradations of risk. It's important to just know that that's out there for the donor, because the result, as you say, would be not what the donor's intending. That may.
And there's a whole line of cases on prearranged sale, and we could do a whole day on prearranged sale, but that's not the topic for today, but it's a very important consideration. And
it almost always will come up in a gift of a business interest. The next slide just talks a little bit, again, just for your reference, about estate taxes. When a business interest is given at death, there are estate tax deductions attributable to that based on the form of the gift, et cetera. This just clues you in to that issue so that you're aware of it. So the donor may be looking for that sort of deduction as well if it's going to be a testamentary type gift. As I said, when, have we lost our mouse? Sorry, people. Get out of that screen.
Yep.
We fixed one problem.
No.
There we go.
There we go.
All right. So I mentioned that philanthropy and giving to charity can play a part in business succession. So I wanted just to identify, if you're dealing with a business owner who's sort of looking at those issues, you know, where will I as the founder of the business be in 5 years or 10 years? If the donor is looking at business succession goals and transferring ultimately the business to children, philanthropy can play a role for a philanthropically inclined donor. Making a charitable gift, and I'll give you an example in just a moment, can effect control to the children without gift tax, which is something many donors will be interested in. So they can minimize that gift and estate tax by incorporating their philanthropy into their business succession plan. They'll be concerned about things like how to be fair to the other kids, those sorts of things. They're not your issues, but if you're attuned to a donor who is thinking about business succession, getting the business on to children, this may be something you can think about when you're talking with that donor about a charitable gift, how to incorporate that into that plan. There's a number of other sort of basic ideas when you're looking at gifts of business interest that you should be aware of. again, many of these are the donor's issues, but as the person dealing with the donor, as the person looking to encourage the donor to make a gift, you'll want to be helpful to the donor in doing that. When a donor is making a gift of a business interest, he's going to need a qualified appraisal. A qualified appraisal is not just an everyday appraisal. There are very strict requirements as to what it has to say and what types of information it has to include that go beyond just a typical business appraisal. The donor needs to be aware that if the donor is giving a minority interest in the business, that has to be considered in his charitable deduction. He can't ignore that as part of his charitable deduction. We're dealing with charities fairly often when they're talking with a donor about this, or accountants or business owners, where we're talking about these requirements. And it's really important these days. It must be every, I don't know, third or fourth private letter ruling I get crossing my desk from that the IRS is issuing is having to do with charitable substantiation issues these days. And so it's an issue that the IRS is paying attention to. Are the appraisals appropriate? Are they sufficient? Those sorts of things. So the donor needs to be aware that that's kind of a hot topic with the IRS these days. Some issues that the donor and the charity need to worry about, or mostly the charity needs to be aware of this when it holds these assets or accepts these assets, are that if the charity is considering taking in a business interest and potentially selling it back to the company, back to the children, there are some rules out there that say that the charity, if it's a public charity, the charity cannot provide an undue benefit to the donor or the donor's related people in that sort of transaction. So if the charity is going to sell it back to the children, it shouldn't do that in a bargain sale type transaction. It should be fair value, fair terms, et cetera. The excess benefit rules prevent or really essentially prohibit charities from engaging in a transaction that provides an undue financial benefit to the donor or his disqualified people. If the gift, and we'll talk about gifts of business interest to charitable trusts, for example, or private foundations or donor advised funds, for those kinds of entities or strategies, there are self-dealing issues if there are transactions with the donor or his family that prevent or prohibit the transaction, and in some of those cases it just prohibits the transaction, irrespective of fairness. So it's important to be aware of the end game. So once you accept that interest, what are you going to do with it? Are you going to dispose of it? Are you going to sell it back to somebody in the family? And if so, you have to be aware of these kinds of issues up front and how that can work, if it can work. There's some other qualifications or prohibitions. If you're talking about donor advised funds, CRTs, charitable lead trusts, there's a rule that says that an entity like that, when combined with the donors and the donor's family, their other holdings, cannot hold more than a certain percentage of the business. Very complex rules, some exceptions, but it's important to be aware of this rule and that it exists. Again, it's it's going to be potentially your issue if it's a charitable remainder trust, for example, or a charitable lead trust that has these issues. So it's important to be aware that these issues exist or these rules exist, specifically when you're dealing with business interests.
Let's talk about some of the issues that are for the charity alone and that the charity needs to look out for and do its due diligence before accepting the gift. A lot of times, with both corporations, LLCs, and partnerships, there might be provisions in the governing documents that allow for capital calls. So that means that the owners could have to pony up some of their own money if the business is short on money, if the business needs money for expansion. And a lot of times, in order to effect a capital call, it does not require a 100% vote of the ownership interest. It's usually a supermajority of some kind, so maybe a vote of 2/3 of the owners can effect a capital call. Well, if you're a charity, you don't want to have to participate in a capital call. So that's something to look out for and carve out if the ownership documents provide for the risk. The other issue is unrelated business taxable income. As we discussed earlier, all subchapter S income is considered to be UBTI, and that's whether or not it's income related to the business or passive income. With a partnership or with an LLC, that portion of the income that is passive, that is dividends, interest, capital gain, is not considered to be UBTI, but the rest of the business income is considered to be UBTI. Now, what some charities will do is set up what's called a blocker corporation, which is a C corporation that will take title to these gifts, and the C corporation pays its own tax, so that there won't be any UBTI going to the charity. And that works for gifts of C corporation stock, it works for gifts of LLC interest, but it doesn't work for gifts of S corporations because a C corporation is not a permitted S corporation shareholder. So if you're taking a gift of S corporation stock, you may have to live with the fact that you're going to have some UBTI. And if you're taking a gift of S corporation stock and you're a 501c3, that works. But if you're a trust, only certain kinds of trusts, very limited, can be permitted S corporation shareholders. Most types of charitable trusts will not be. So that's a consequence both to the charity and the owner, because if you take title to S corporation stock and you're not a permitted shareholder, you blow the S election at the moment you take title, which would normally be a disaster for the other owners of the corporation. Does everyone know what UBTI is? It's unrelated business taxable income. It's income that is derived from a business that is not related to the charitable purpose of the charity.
And maybe just to add in, for a public charity, the tax rate on UBTI is the corporate tax rate. So for a public charity, it may be that, that you're okay getting some UBTI. You still got a gift, but there's going to be, a tax on that. As you mentioned, for a charitable trust, like a CRT, UBTI is taxed at 100%. So for a trust, it's just not a viable sort of thing. So
another issue for the charity is you're going to be a co-owner with other owners, and usually you're going to be a minority owner, and quite often a very small minority owner. So if you have 1% or 2% or 5% of a company, you have to think that you really have no control over what could happen. Again, most ownership documents provide for supermajority control. Most ownership documents provide that the ownership documents themselves can be amended with less than a 100% vote. Oftentimes, you'll see a provision that says the ownership document can be amended with a 2/3 vote or a 75%. Well, if you're a 1% shareholder, you're at risk of somebody coming in and saying, we're going to amend the ownership documents to provide that we now permit capital calls, or that all owners have to come up with an additional contribution to the company. Now we're going to talk about some of the items that you have to look for when you do your due diligence. And these are things that the charity should request or the charity should ensure are done before accepting the gift. Is the business entity managed in a normal business-like manner? Is it well run? Are the financial results audited? Is it a general partnership? Again, you want to look for these things that indicate something's wrong. Does the business present any special risk to the charity, such as a reputational risk or an unusual liability? We represented a charity that accepted a gift from of an interest in a country where, let's say, bribery is more common than it is in this country. And that was a potential reputational risk to the company, and they negotiated a provision that would basically let them walk away if the need arose. So you have to look for things like that. Have there been any recent unusual distributions of cash or incurrences of liabilities? If so, what are they for, and what were the liabilities incurred, and is there any risk to the shareholders or owners? And do the organizational and ownership documents adequately protect minority owners? I'm going to talk about this a couple times, but there's a concept in ownership of closely held entities called a tag-along concept, and also a drag-along concept. A drag-along is if the majority of the owners want to sell to a third party, they can drag along the minority owners and force them to participate in the arrangement. And most often, if you accept a gift in an entity and you're a minority, you can expect to see a drag-along provision because the majority wants the ability to say, we want to sell the company, and they don't want a 1% or a 5% holdout that can blow up the deal. So you can expect to see a drag-along provision, but what you should want to see as a minority owner is the corresponding tag-along provision. And that means that when the owner goes and sells 95%, they can't leave you out there twisting in the wind with your 5%. You have the right as a minority owner to say, I want to tag along on this deal, and I want to sell my interest at the same rate everybody else is doing. So those are some things to look for. I mentioned earlier that you also want to look for provisions on capital calls, and you want to look for what it takes to amend the ownership documents. You want the ability to say, if you provide for capital calls, they don't apply to us. Or if you provide for amendments with less than a 100% vote, if it's an amendment that affects our interest, you have to get our consent. So what kind of documents should you look at, or should your counsel look at when you're doing your due diligence? You should get copies of all the organizational documents, articles of incorporation, bylaws, operating agreement, et cetera. You should get a list of the owners of the entity, who owns how much, what their relationship to the donor is. Are they all family members? Are they third parties? Any buy-sell agreements, any shareholder agreements, partnerships agreements, et cetera. We recommend getting the last 3 years of tax returns and the last 2 years of audited financial statements. Usually the more the better. You would want to know whether or not the business is engaged in any political or legislative activity that could affect your status. You would want to know the annual net income from each type of activity, passive activity versus active activity, business activity. You want to know how much UBTI there's going to be. And to know that, you really need to do a deep dive into the net income of the entity. You need to know the method of allocation of income and losses if it's a partnership or an LLC. How much of this is going to flow down to you, especially if there's going to be UBTI when it does flow down to you. You also want to look at how people get paid out when the entity is sold or when there is liquidity. Often, if you're a 1% owner in a partnership, it's not as simple as I get 1% of the proceeds. It might be that there are senior investors who might have, a preferred class of equity and they get paid first before any of the junior class get paid. There might be 4 or 5 levels of equity owners, and the first 4 get paid before the last one. So you want to know where you are on that list. Again, you want to know if there's a capital call provision. You want to know if there are any other carrying costs associated with ownership. Usually there are not, but you want to know that. Is there debt to the business that you will be assuming? Generally, you wouldn't want to assume debt, but some cases you might. And if you did, there might be a bargain sale issue. Any non-U.S. assets. I mentioned the example where we accepted a gift of an entity in a different country. If you do, you want to be very careful and look at the ownership documents and possibly retain counsel in that country to help you. And we already mentioned drag-along and tag-along rights. We mentioned how the appraisal is useful to the owner in securing the tax deduction. It's also going to be useful to you. It'll help you determine what the total fair market value. The appraiser will look at the company differently than an auditor will. The appraiser will look at competing businesses, what the prospects are, et cetera, and an auditor won't do that. So it's useful to you in considering whether or not to accept the gift. You'll also want to look at transactions and relationships with the donor's family, and other family-owned businesses, especially if, there are children in the wings who may be potential buyers or other family members who may be potential buyers sometime down the road. And the contemplated disposition of the interest. There are two most common scenarios. One is that there might be existing owners that might eventually purchase your interest. And the other is that there might be a third party out there who's potentially buying the company. And hopefully the owner has come to you long before any of these potential exits will happen to avoid the prearranged sale issue. But those are the two most common scenarios. What is the prearranged sale issue? If an owner comes to you, you would hope that the owner would come to you and say, I might want to sell my business in 3 or 5 years, and I don't know to who yet, I don't know for how much, but I'm feeling charitable and I would like to donate some of my interest to you. That's not usually the way it works. There's sort of a sliding slope here, slippery slope. The owner will generally have already made the decision to sell their business. Hopefully they won't know to whom. They may have engaged a broker to help them sell their business. I don't think engaging a broker is fatal, but it's certainly worth discussing. But if the owner has identified a buyer, if the owner has a letter of intent, certainly if the owner has a purchase agreement, there is very definitely a prearranged sale issue. Now, there are cases all over the board. There are even cases where there's been a purchase agreement, but there were conditions in the purchase agreement that were so substantial that the court found that there wasn't a prearranged sale. So I don't think you can say anytime you have a set of circumstances, it is or is not a prearranged sale. But you know that the closer you get to identifying a buyer, the closer you get to identifying a price, the more likely it is that you will have a prearranged sale issue. Another issue you will look for in any ownership documents are restrictions on transfer of your interest. You obviously want the ability to sell your interest at any time. If you've got a buyer out there, whether the buyer be a family member, whether the buyer be the third party, you want the ability to sell. But most privately held companies don't give minority owners especially the right to sell without a couple things. First of all, you might have to get consent from the majority, from a general partner. Secondly, you might have to give the other owners a right of first refusal. There might be side agreements with other owners, giving particular owners a right or an option to purchase. And there's usually a procedure set forth as to how to waive that provision. There's also usually a set of procedures around what are called permitted transfers. Ideally, you would negotiate a clause that says, if charity sells, it's a permitted transfer, but that may not be possible. So you should understand what the restrictions are, what the limitations are, whose consent you have to get to sell. And again, you want to make sure you get those tag-along rights, so when they do go out and sell the 99%, you can follow right along with your 1%.
Well, let's talk a little bit then about, did we move? Thank you. All right, let's talk a little bit about some structures or some strategies when you're talking with a donor about a gift of a business interest. Assuming you've vetted all of the due diligence issues, assuming that the business interest is something that is of interest in accepting, there's a number of strategies that might be relevant to a donor or forms of gifts that might be relevant to a donor. The simplest is an outright gift of the business interest to you, followed by redemption of that interest by the company. This is one of those business succession strategies that you should be aware of for a donor who might be philanthropic but also interested in transferring his business on to his children at some point. You would have to vet all of those sorts of issues that Barry has talked about in this context. So if there was restrictions in the document about transfers or provisions in the document about that, you would have to understand what those are to think through what's the plan here ultimately for this interest that you're receiving. I suppose maybe it doesn't go without saying, but most charities are not interested in holding on to that business interest for a long period of time. You're not business owners. It may not be the kind of investment with risks, et cetera, that you want to hold on to for a period of time. So most charities really are interested in holding that interest short term and then ultimately liquidating it. Cash is something the charities are typically after, and the business interest is illiquid, may not throw off income, et cetera. So really the end game is usually not to hold on to it. So really the exit strategy is something to pay attention to both at the beginning, and then this talks about a little bit, kind of how it happens. So in that context, you've accepted the interest, or you're going to accept the interest. You do have to think about the prearranged sale idea, alert the donor to it. You have to think about, for the period that you do own the interest or hold the interest, what are the tax implications, if any, to you? Is it UBTI that you have to be aware of? Now, as I mentioned, if you're receiving UBTI, that's maybe not the end of the world. If it's just a gift that you've received outright, there would be a tax on it, but you still have received a gift. So it's something to be aware of. It may not prevent the gift, but you will have to think about things like, what if the donor is giving you that stock in satisfaction of a pledge? What is the dollar value you're going to credit the donor with, if in fact there's going to be UBTI associated with that interest? Are you going to credit the donor with less against his or her pledge? There are the issues of excess benefit that you would have to think about, and the question of subchapter S, Barry indicated that a public charity can hold subchapter S stock. We'll talk about some of these other ideas where the subchapter S issue is a significant issue. In terms of how this might work for a donor, I have an example on this slide. Let's say you have a donor who has 1,000 shares in his company. Let's say the value is $1,000 a share. Right now the owner has 60%, the donor does. His children already own 40%. This is just an example to show you how this might work. If the donor was to make gifts of 70 shares a year to you, okay, the donor is going to get a deduction for that $70,000 a year. If the children turn around and buy the interest from the charity, or if the company redeems the interest from the charity, de facto, the donor's interest goes down and the children's interest increases. And so that strategy around giving to charity with ultimately having the company or the children take that interest from the company or from the charity, buy it. The charity walks away with cash, which is what the charity was intending to do in the first place. And the donor has been able to pass on value and percentage ownership in the company without making a gift for gift tax purposes. In fact, the donor's gotten an income tax deduction. So it's a win-win for the donor and his family and his business succession. He's been philanthropic, which was one of his objectives in the first place. The charity ends up with cash and everybody's happy.
And this is one where you want to watch very carefully about prearranged sale issues, because if you've got 3 years in a row where it's a December 31st gift and a January 2nd redemption, you want to be very careful.
Yes, it is important to watch for that.
You have a question?
Yep.
Again, it's not your issue. You get the gift no matter what. And, you know, they aren't going to come back and say, give us the gift back or give us some of that money. But, you know, if that happens on year 2, you're not going to get the gift on year 3. So it's something you need to be concerned about and need to watch. But it's basically putting it back to the donor to go talk to their own counsel.
Right. I think that's the key point. You know, you don't want to be the cog in the wheel of the plan. You want a gift. And, you know, in this context, you receive the gift. But the donor needs to be aware of what the risk is in terms of the prearranged sale idea. It is a bit of a balancing act, because if the donor says, well, I don't want to have prearranged sale problems, so I'm not going to have my kids buy this stock or have the company redeem the stock until, you know, 6 months from now or a year from now, you're holding the interest for that period, right? The due diligence is really important. You know, you're going to have potential UBTI, you're going to have co-ownership, you're going to be subject to the agreements that exist, all of that. So you have to operate as if you're going to hold it for a period of time. You can't ignore the due diligence thinking it's going to get bought pretty quickly and you don't need to worry about anything, okay?
And your development people need to be aware of this as well. We had a situation once where one of the development officers had written in their notes after a conversation with the donor, you know, redemption next year or something like that, and that's one of the things that can be poison.
Right. The communication and the record, be thinking about that, because these do get audited, and the IRS can go to the charity and get its record about these. The next strategy I just want to cover, oh, I think I advanced too far.
No, you're right.
Well, I wanted to be on the prior slide. So this CRT redemption, the idea of using a charitable remainder trust really achieves some of the same ideas of this transfer of control to the children, et cetera. There's a couple things that are different, though, to think about. First of all, for a donor that is looking for income from that interest, the charitable remainder trust or charitable gift annuity structure provides that income to the donor. So the donor is going to be looking to a structure like that potentially instead of an outright gift. But those structures are more complex and more considerations have to be thought about in doing that. The UBTI, as we mentioned in a charitable remainder trust, is taxed at 100%. Okay? A charitable remainder trust cannot hold subchapter S stock and retain the subchapter S status. It terminates. The self-dealing rules come into play when you have a charitable remainder trust. So if the end game is that the company will redeem the stock, well, let's step back one step. The children cannot redeem the stock or cannot buy the stock from a CRT. That's self-dealing. There's an exception to the self-dealing rules for a redemption of stock by the company under certain conditions. And those conditions are that the offer of redemption has to be made to all shareholders, not just the CRT, and it has to be on fair terms, same terms for all shareholders. So where that is an issue is if there are shareholders who the donor does not want to redeem for some reason, the offer of redemption has to go out to everybody. And so that leaves those shareholders free to offer up their shares for redemption. And so that idea is distasteful to some donors, and you would need to know that first before you go into a CRT type transaction for that interest, because that's the exception that you would have to use to get it redeemed by the company so that the shares go back to the family. This slide deals with a charitable gift annuity gift with a redemption. The same issues or the same purposes really will apply as a CRT, where the donor would retain an income stream from the gift. For a CGA, it is a gift to the charity. It's not a separate trust. Because it's a gift to the charity. If it's a public charity, the self-dealing rules don't apply, but the excess benefit rules do. So there can't be transactions with the donor's family that have an undue sort of benefit to the donor. There are risks, as we've discussed, in what is the value of that gift. If you're issuing a CGA in exchange for a business interest, what value are you going to use? What value can you rely on? Business interests are not often accepted in exchange for CGAs for that reason, because it's a pretty risky business to be basing your CGA payments on the value of a business when that value could be right or wrong. You may be dealing with a donor who says, I will leave these interests to charity at death, but not now. So let's talk a little bit about a couple of those things in the time we have left. We have about 5 minutes if we want to allow time for questions. Oftentimes, a charitable lead annuity trust is used. And if you're familiar with a charitable lead annuity trust, it's a trust that provides payments to charity for a period of time, and the remainder goes to the donor's family. We've got a number of these in the office right now. Donors will use that sort of gift to reduce estate taxes, but still pass business interest on to charity. There are some special rules that apply to charitable lead trusts. For example, one of them is the excess business holdings rule. And we talked about that a little bit, where a charitable entity cannot own more than a certain minimum percentage of a company. And if it does own more than that, it has to divest of that excess. The charitable lead trust can have up to 60% of its total value attributable to the charitable deduction before it runs afoul of that rule. But what that means is that you can't put 100% of a business into a charitable lead trust. There's also issues if the trust holds business interest, how is it going to pay the charity, what the charity is entitled to for that first period of time? And there's a number of ways it can do that. It can take the income from the entity to pay those interests. There's a couple other things to be aware of when you're thinking of a donor who's looking at a charitable lead trust option. The S corporation status does not carry over with a charitable lead trust. So again, terminating the S corp election would happen if that type of stock is transferred to this type of trust. Sometimes people will provide for the business interest to pass to a charitable lead trust at death and then give the children an option to purchase that interest. Remember, a charitable lead trust is subject to self-dealing rules. Also, a donor's estate is subject to self-dealing rules if the end beneficiary is a charity. So the interim estate is also subject to those rules. So if a donor is going to do this kind of planning where an interest is going to go to charity in the business, but the end game is the children are going to purchase that interest or the company will redeem the interest, there is an exception in the Internal Revenue Code to the self-dealing rules, but it's a very narrow exception. It has to be followed exactly to exempt a transaction in which the children purchase the interest or the company redeems the interest. And that exception requires that there be court approval, that there be an existing option, that the estate or the charitable lead trust receives fair value, and that the sale occurs during that period of administration. So there is a way to get it done, but the donor should be talking to his advisors about how to get it done, how to plan for it, so that the self-dealing rules don't muddy the waters in terms of that gift to you. I'm going to just move quickly here. The final one I just want to talk about, and again, this just raises some of these rules to be aware of. If the donor make a gift to the private foundation, his own private foundation, those entities are subject to these same self-dealing rules that would apply, and that entity is also subject to the excess business holdings rule. We have a client right now we're working with who wants to leave his business interests to his private foundation at the end of the day, and we're having to do a lot of planning around how to do that to take advantage of the estate exception, to make sure we're going to fall within that, to avoid that self-dealing problem, because the end game is that the children will turn around and buy that interest from the estate at the end of the day, so that the company remains in the family and the cash goes to the private foundation. But the planning is essential in order to make sure that it gets done correctly. So with that, I think we wanted to leave some time for questions at the end or comments.
We have no chat from the people watching the webinar.
Okay, that's either good or bad. So, yeah, so if people have questions, otherwise if you wanted to stop up and talk to us afterwards with a private question, that's fine too. Have people, I suppose this would be an interesting point. How many people in the room have worked with business interests in your charity and received them? Okay, couple. Well, it's, you know, it really is, I think, an area that's going to be ripe for looking at going forward. You've got, you know, the baby boomers retiring. Just the demographics, I think, are going to speak to getting sort of up to speed on these kinds of gifts and being able to seek them out and then work with them. So it's an important topic. Oh, there's some questions. Yeah. Kim. Okay. Yes. 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 Yes, you're absolutely right.
Because even most real estate is going to be in an LLC or a partnership. So
that's right.
It's very unlikely that you'd get an undivided interest in the real estate itself.
Although one thing we deal with a, you know, a fair amount is, you know, farmers and real estate. You'll see, you know, individuals oftentimes with farmland gifting that. I don't know why. I mean, we're in Minnesota, so that's possibly why we see a fair amount of that, but we do. And oftentimes those are not in LLCs. They're just individually held just because they haven't quite caught up with
and that's usually a fairly easy one because farmland is a fairly fungible commodity, and it's,
right.
you know what the per acre price is in Todd County, and
right.
they can figure that out.
Right. But you're right. I mean, it's some of the same considerations will apply. So you've got, you know, the donor's going to have to look at his deduction limits. He's going to have to look at, you know, you're going to have to look at UBTI issues. There's going to be the issues around prearranged sale, potentially. And again, hopefully not, but those things will still apply. You won't have the, you know, termination of subchapter S and, you know, those sorts of entity issues to look at.
Is there another question over here?
Well, one thing that I can recommend is, you know, kind of the first step in that process is to engage your board and development people in putting together a gift acceptance policy. So thinking through at the front end, what are some of these risks, and, you know, so that if you're faced with a gift, you can sort of look to the policy and say, well, this, you know, gift has this attribute, and we've, as a, you know, as an organization have said that if that's the case, we have to do A, B, and C. or, you know, or we won't accept it if it has some attribute. And so going through that process in a really thoughtful, measured way so that you institute a policy about those kinds of gifts, that can take you, you know, a step of the way. Now, every case could be different, but you can identify some of those areas where you would want to have further inquiry, and then, you know, this is self-serving, but work with good counsel who can help you vet some of those gifts and some of those issues.
You can also start opening your donor's eyes as to the possibility of a gift of an interest like this. I mean, you may be talking to a donor who might have limited liquidity in terms of cash that they can give, but they might be a business owner. And even though you can't afford to give me a lot of cash right now, you might be able to give me a 1% interest in your company.
Any other thoughts on that in the room? We've got lots of seasoned planners here. Okay.
Well, thanks for coming, everybody.
All righty, thank you.
Take muffins on your way out.
Yes, eat more food. I always have too much
Take
food.
leftovers.
All right, well, I'm going to make a note.
Thank you to those on webinar. We're turning it off.